Welcome back. Two more Canadian banks, of course, have reported earnings this morning. The investor reaction is very different. Royal Bank of shares are rising. National Bank of Canada shares are down. Joining me in studio to talk about the numbers, Alex MacDonald, Portfolio Manager at Globe Invest Capital Management. First of all, Alex, thanks for being here.
Good to see you again, Paul.
So let's talk about the national numbers first. There's something in these numbers that the market doesn't like, and I think credit costs are part of the story there.
Yeah, the PCLs, the provisions for credit losses. National has, in recent history, done a very good job on that front. So PCLs are what a bank puts through their income statement in anticipation of maybe not getting back 100 cents on the dollar of a loan they have outstanding. Of course, here we are in Canada. If we take a step back, with rising rates, people are worried about mortgage renewals in 2025.
Right.
So if we think back a year or so ago, there was anticipated to be a big mortgage cliff. As rates are significantly higher than when they were when people may have started these mortgages or renewed them last during the pandemic, when they have to go out and renew them again, there are questions about whether or not they can afford to do so. So PCLs would be put in place in anticipation of that by a bank to maybe say that they're not getting back 100 cents on the dollar. So National, even though it met on its EPS number, it's what we would consider a low quality beat because the PCLs were higher, and those are really important because of what I just mentioned. But it made up for it with a lower tax rate. And generally, when people look to invest in a Canadian bank, it doesn't necessarily do it because of its ability to keep taxes low at above average levels. So that, I think, is one of the reasons why we're seeing National get punished a bit today.
Over the years, investors and portfolio managers have liked the management team at National, liked its ability to execute. And I think more and more people are liking the Canadian Western Bank acquisition, although it's common to hear that National didn't get a bargain in terms of the pricing on Canadian National. Are these shares, is this a buying opportunity for investors who want to get into one of the big six banks?
So I think if you look at the big six banks, there's sort of the haves and the have-nots over recent periods. So National, I would put in the have bucket along with the likes of Royal, which we'll talk about in a minute. As a result, their valuation is at a premium compared to the rest of the group.
Almost 13 times. I'm seeing on National 12.9 times.
Correct, yeah. So if you have that premium, investors expect you to execute almost flawlessly to justify that valuation. And when you don't, if there's a misstep like we saw with these quarterly results, that's how your valuation can fall back. But even so, it's still trading at a pretty hefty multiple. As you mentioned, there is the Canadian Western acquisition that people think is actually going to close a little faster than maybe was previously expected. I think there's still some integration risk, though. Like it's a pretty big company to bring in under the wing. And with any sort of M&A, there's always questions about will companies actually realize the synergies they set out to do? And there's always problems with, making sure the cultures align. So we don't own National. It's not one of our bank holdings. And I think we'd have to see more of a pullback in valuation before we stepped in.
Okay. Royal Bank of Canada numbers. The market likes these numbers. The stock moves higher again.
Yeah. So Royal beat on EPS numbers. And this, I think, would be considered a much more high quality beat. So the PCLs that we talked about with National, basically in line with what the market was expecting for Royal. Again, if we look about whether Canadian consumers are going to start not being able to pay their mortgage default in 2025, Royal, at least what they're saying now is that's not as big of a deal as maybe what some people had feared. In addition, speaking of acquisitions and synergies, they've increased their synergy target for HSBC Canada, pulled it forward a little bit. So they think by the end of this year, or they've said by the end of fiscal 2024, that they're ahead of what their previous target was for their synergies. So the market's going to like that as well, because again, there's integration risk with M&A. And like National as well, increased its dividend 4%. It also was trading at one of those premium valuations, but if you continue to execute like they did in this corner, then the market will continue to reward it. So Royal is one of our holdings, and we do continue to like it here.
Our first guest of the morning echoed much of what you had to say, but said that he would not be a buyer right now of Royal. He also holds it in his client portfolios. He just looks at the multiple. The PE multiple is almost 14 times on Royal Bank of Canada. So how should investors think about that multiple?
So there's the qualitative side of the multiple that you can look at. I mean, at a high level, a multiple only tells you so much about the completely, the complicated operations of a bank. But, compared to the peers, it is a little higher. But as I said, on the qualitative side of things, Royal's been executing. They've been doing a great job, both on their quarterly results and with their execution on the HSBC integration. We also like their geographic diversity. So they do have some exposure, of course, to the Canadian mortgage market, but their capital markets business in the United States is also pretty significant too. So it gives you some of the exposure outside of Canadian borders. We wouldn't increase our position, I don't think, at these levels. But if we had some new client money we had to buy for, we would certainly not hesitate adding Royal to their accounts.
The bank stocks have done well, particularly since the early portion of August, a long-awaited rally, really, for Canadian investors. Many, if not, I think most Canadian investors obviously own in one way or another these stocks. And after a couple of years of these stocks just kicking along sideways, finally they've caught a bid. Do you think the group can move higher yet in 2025?
I do. So in addition to Royal, we also own TD and Scotia, which have been trading at more of a discounted multiple. But I do think in 2025, it's a big year for investors looking at the banks because there was, first of all, that mortgage cliff renewal concern that seems to have abated somewhat. And now banks are actually talking about being a little bit more aggressive with mortgage growth. On the call this morning that Royal had, they actually said there's a lot of pent-up demand for housing. The people have been sitting on the sideline as rates came up. So now as they come down, they might see some of that pent-up demand jump into the market. And then yesterday, Scotia on their call actually said that lowering rates, as most people expect, is going to happen in the new year. That's going to help a lot of their mortgage clients, make it a lot more affordable for them to go out and renew in 2025. And then, of course, new clients coming in as well, too. Maybe those first-time home buyers that weren't active in the market will step in as well. And then, of course, with the back to the PCLs with their rate cuts. Now, Scotia did actually forecast that PCLs in the first half of 2025 will tick up a bit from what we've seen at the end of 2024. But as those rate cuts take hold, PCLs, at least what they're forecasting now, are going to start ticking back down in the second half of 2025. So I think if that does come to fruition, if that does happen, then you can see the multiples of some of these laggards in the banking sector start to increase. Alex.